Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the mayor, the governor, and the great state of real estate in Texas, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. Getting ready. Old Capital Conference is upon us, so getting excited for that.
Yeah, it's always a great event. The Old Capital Conference coming up here September 9th and 10th. If you don't have a ticket to join us, I encourage you to go to oldcapitalconference.com. We have it this year at the George Bush Museum. We think it's the premier event in North Texas or in Texas about people that get together and kind of talk about real estate. These are the players that you want to get to know, whether they are investors or they're general partners, or as we say, limited partners, the people in the front of the airplane or the people in the back of the airplane that just want to get their Coke and their peanuts and want to invest with the pilots that are driving the airplane, so to speak. We have people from management companies. We have people from attorney groups, tax savings groups, all kinds of people that are going to be there. So if you're thinking about getting into multifamily, we want you to go and be part of a great event that's kind of a classic event. We think it's the best event for you if you're getting into apartment investing. Before you start spending your hard-earned money, come to the Old Capital Conference, oldcapitalconference.com, and join us. So, Mr. Michael Becker, what do you call an instrument that measures temperatures?
Thermostat, I guess.
Or thermometer.
Thermometer, there you go. Yeah.
What do you call an instrument that measures wind direction? Wind direction.
Put me on the spot. A barometer.
A wind vane. A wind vane. Okay. That's what you see up on the top of some of these houses. It says that north, south, east, and west. It kind of measures where the wind is coming from. And this is an easy one. What do you call an instrument that measures a vehicle's speed?
Speedometer.
Excellent. I love it. 8
years of college at work right here. Look at that.
Yeah, that was an easy one.
So what do you call an Ochstein?
I'm sure he's called a lot of things by a lot of people. So
yeah, a lot.
He's a measuring device that gives us an historical perspective of the apartment market in North Texas. So he determines and helps us understand, is it a good market? Is it a bad market? Is he investing? Is he buying properties? So on the show today, we have the guy that everyone turns to kind of figure out if it's a good market or not, or people should be investing or not. I want everybody to say hello to Michael Ochstein. Mike, how are you?
I'm terrific. Thanks for the opportunity to be on today.
Mike is with Price Realty here in the Dallas-Fort Worth area. He buys properties not only in Dallas-Fort Worth, and Austin, San Antonio, Houston. He has a great perspective about what is going on in the Dallas-Fort Worth market and the rest of the Texas market. So we kind of turn to Mike Ochstein with Price Realty to kind of give us an idea about what's going on. Michael Becker, we had Mike Ochstein up on stage last year at the Old Capital Conference, kind of talking a little bit about his perspective about in the market back last year. Do you remember what Ochstein was talking about last year, Michael?
No, I think I got cornered when Mike was on stage. So what did he say? You put me on the spot today.
It was great. And so I want to have Mike kind of talk a little bit about his perspective, because he's been doing this, I'm going to say, a little bit longer than I have. So I think you started off 81, 83, Ochstein. When did you start?
With Marcus and Millichap back right out of college in 82.
Wow. Give us a background, and we'll talk a little bit about the conference from last year and what you expect to talk about maybe this year too. But give us a little background of Mike Ochstein.
Well, I'll start where we're at today. We have about 5,500 units spread out between Dallas, Houston, and Austin. The last couple of deals have been bought in Houston, a brand new property in Richmond, great growth area. Felt like it was well below replacement cost at $190 a door, great submarket. And another perspective, my son joined us in January and sourced a deal off market in Fort Worth, kind of how I started in the old days off of Mockingbird and Skillman. It was a deal that I probably wouldn't consider buying for myself today, but it was a deal where my son sourced. It was in a great location. It was 116 units. Felt like it was a great price per unit, great cap rate, et cetera. Took advantage. The higher interest rates creates higher cap rates and lower price per unit, and felt really good about the basis. That's why we're kind of excited today about buying today, a little bit higher cap rates going in, a little bit better price per unit, ability maybe down the road for some cap rate compression, who knows? Right now we're just looking to buy quality, well-located assets right now we're not in San Antonio, but we're in the three major markets of Dallas, Houston, and Austin. Recently we have just spent over $150 million in Houston. So our focus really is take advantage of the softness in Austin and try to be competitive in Dallas. I think a lot of people want to be in Dallas. I mean, Michael, you agree with this? I've been spending time with some of the institutional guys, like EQR is back buying aggressively in DFW. It's hard to compete when you got a guy who can just strike a check. Right now we have several off out. I mean, there's a lot of competition to buy in DFW versus maybe buying in Houston or buying in Austin.
Yeah, no, I would concur with that for sure. Dallas is we're back, right? I mean, it's like
we never left. Really.
It's not just EQR, it's Blackstone, it's Goldman, it's KKR. They all bought here, and each one of the competitors that haven't bought here are trying to actively buy here. And there's a bunch. I just went to the Cowboys game a week or so ago with a bunch of the top brokers in town, and talking with these guys. They have 12, 15 listings out of high quality, and kind of seeing where they're talking about setting at pricing expectations. They start hitting some of those strike numbers. I mean, they're setting pretty big data points all of a sudden on some newer construction in Dallas-Fort Worth. So I'd concur in Austin's much easier from a competition standpoint, but the fundamentals are pretty soft in Austin right now with vacancy and rents. Rents are soft and have negative trade outs and stuff like that. But I mean, hell, if you could buy there, it's a lot cheaper than Dallas at this moment in time. And it's a moment in time.
It turns quickly in Austin.
Yeah, it does. It does. So yeah, maybe kind of talk about that too. So you wouldn't I know you've been kind of steadily buying onesie twosies here and there for the last decade, but before that you had a pretty big push kind of coming out of the Great Recession, kind of the early parts of the 2010s. You bought a whole bunch of deals at that moment in time, and then you really just had a hard time kind of buying for many years. And so I think you kind of mentioned that the cap rate's a little higher and things like that. What made you say, hey, this is 2024, this is the time I need to really put the foot on the gas? What really was behind that?
Well, early on, I remember underwriting deals and, putting 3.5% debt, and the cash flow coming out of the chute is 3-4%. I go, what's that tell you, to my acquisition guys? These valuations are too high. You're not, I started buying in 88. Everything was 8, 9, 10 cap rates, and you're walking in 7, 8, 9% cash on. I've always been a cash on cash buyer. And so, that's why last year was like 21, just kind of took the foot off the pedal because there wasn't any cash flow on any of these assets. So today, if you can buy to a year 1, 5 or a year 2, 5.25, 5.5, and you feel really good about the basis. And I think, some of this newer stuff in the low 200s or 180 to 200 feels really good, and there was just an asset. I wish I would have just pulled the trigger 121, and I'm sure you looked at it in Josie Road. It was, I'm spacing the name, but it was like
Provenza?
210 a door for 121, and
The
the real,
The Provenza.
I don't know, but it was just north of that one.
Oh,
But
yeah.
it sold for like 212 a door.
Yeah.
I mean, that just feels like an unbelievable basis. Now you got a lot of supply, and you're going to have to manage through that. You're going to have to educate your investors. Hey, the cash flow is going to be minimal the first couple of years, but should at that basis, 3, 4, 5, 6 years down the road, I think it's going to provide a great return. But I'm going to congratulate that guy in 4 years because I didn't pull the trigger to buy it. So that's what's getting me kind of excited. The price per unit, the higher cap rate, borrowing at the higher rates, 3, 4 years. I don't think, do we ever get back to the 3s? Maybe not, but do we get back in the low to mid 4s? Probably. We're almost there now with the buy downs.
No,
So
yeah,
that's what's getting me really excited.
we're able to borrow the four handle on the rates with a 1.25 buy down, all day. So
Correct.
it's pretty much there. So yeah, maybe tell a little bit about the deal you guys just bought, Fort Worth, right? That you just kind of mentioned a little bit older deal that you told me would have done. What got you excited about that deal, and maybe talk a little bit about that deal story.
Well, it was a great price per unit. It was a great cap rate. The sellers had a cap coming due. It was to some extent needed capital to be put into it. We basically brought in rescue capital. Some of their existing investors stayed in the deal, actually. And it was the first deal that, my son just joined in Source. I was excited for him to get him started and starting to build his own portfolio. And the cash on cash, we're projecting that on a 5-year hold should average, 7%. And the other thing, Mike, that we're kind of excited about it could potentially be, a redevelopment site as well. And you're in the neighborhood, so, it's great quality homes close to downtown. It provides kind of an affordable niche in Fort Worth.
Yeah, no, it's a great location near the Monticello neighborhood. So that's one of the highest end neighborhoods in all of Tarrant County.
Yeah, beautiful property that they bought. Smaller asset. We've done a lot of lending in and around that area. Historical neighborhood, great schools in and around that area. You have a great neighbor next door, which is a cemetery, which makes for quiet neighbors next door.
We like those neighbors.
That's right. We like those neighbors. Fairly busy street that helps you out with marketing to the property. My question is that, was it difficult to raise equity for you in the marketplace? I know you have a big list of investors that you turn to. How difficult is it to raise money these days?
It is. It's really interesting. Even the deal that, we did in Houston a year ago, we put it out on that IMS, and I think within an hour, we had commitments to almost put it to bed.
And what is the IMS?
I was really blessed. I've been very fortunate through all these different cycles. We've never had a legacy, and we didn't even full blown the smaller deal in Fort Worth. We just, because it was such a small raise, we just went out to like 10, 15 investors and it sold out immediately.
Yeah. You didn't have very much money to raise, and it was a good asset to buy. And, you guys were able to close that deal on time and made everyone happy on that deal. We talk about all these devices, with the speedometers and the temperature gauges and the windmill. So I turn to you to let us know and let investors know a little bit what you think about the temperature of the market. We've had a 0.5% interest rate decline. Is that going to fire up investors to come back into the market? We've had cap rates on these higher quality assets, I think maybe stabilized, have come down a little bit from where they were. So where do you think the direction is of the market going right now?
Well, I think Mike would agree, when these investors can put money in T-bills at, 5.25%, and, that's back down to 4.75 today as I last checked. So we're able to go back to these investors and, they have safety, obviously, in the money markets, but no upside, no tax savings at all. So I think it's a really great time for us to be out in the marketplace. First, we can, investing in multifamily with the right, like Mike's track record, if you're the right operator, it's a great, safe place to put your money and a good, safe place to probably, double your money and get pretty decent cash on cash returns that are tax efficient. And with the right person, the investment's safe. It's not a private equity deal. It's, you look at the stock market, it's at an all-time high, the Dow's at an all-time high. Where can you find, it's kind of scary where the stock exchange is right now. It just keeps going. There's got to be some sort of bubble. And I think we've already gotten that in the multifamily space. People are continuing to move to Texas. Jobs are continuing to be created. And it's a safe market. And if you're the right operator and have the right capital reserves, you shouldn't have any issues.
So when you look at a deal, because that property down in Houston was a fairly new property, and the property you guys bought recently was a fairly older property in a good location. Both were in good locations. Is there something that you are focusing in on in your buy box these days?
Yeah, all we want to buy is quality and great locations and good growth stories. And as early on, I told my guys I would go back to my roots and buy 80s product at the right location, the right basis, and the right cap rate. Kind of go back to the roots of generating really good cash on cash returns, even if it's a potential where the guy has a cap. And we've looked at several of those, some of the Tide deals, and I don't know, some of them, like the one, I'm sure you looked at the one Ohio and Plano Road. It was actually built by Zale Properties back in the day in the early 90s. I mean, we underwrote it and I really wanted to buy it, but God, the price that they got was just was fantastic for the seller. We want to buy well located, older, newer. It doesn't matter as long as we feel comfortable with the returns that it's going to provide.
Everybody for the last decade or two has been really, they're talking about value add buying. And then, you guys took your foot off the gas and really did not do a lot of business for a couple of years because you just saw the market was overheated. It was in a bubble, so to speak. People were competing for cash flow that really didn't make sense on properties that they thought were going to appreciate. So they put a lot of adjustable rates on, and these properties are down 25 or 30% in value. So you had the foresight not to put your investors in kind of harm's way in some of the deals that you did. You stepped away from the marketplace itself.
Yeah, we were, like one broker said, my old school HP. So, we're cash flow buyers and some of these value add deals. And then you look at your basis after you're done fixing them up. It's like, might as well buy, core plus product. And we bought a lot in Houston. If you look at the portfolio in Houston, it's all 2010 and newer product. The stuff in Austin, we have, relatively newer assets, 2 newer assets. Here, we had newer assets, with institutional partners. I wish I had a first right or first refusal, but, we sold those. We had several deals with Palladium and Dome Equities that we sold prior to COVID. And the value, we hit home runs, but you can imagine, you can never time the market, right? If I had a right of first refusal, I probably would have still owned those deals today.
The private equity has the right of first refusal, whether they're going to stay with the deal or not. And for you had to go where the money said you guys were going to go, and whether to sell the property or keep the property. And they decided to sell the property.
Yeah, they decided.
So for you guys right now, are you the next, let's say 2025, are you looking for pretty much stabilized properties? Are you looking for value added properties? And, kind of give me what the map is for Price Realty about where you see the market going for you in the next 18 months.
Well, I think it's 2 buckets. We can do, we'll buy the older product at a higher cap rate going in, and we know we can own and manage and turn those around. That's one avenue. I think we, especially being in my own backyard. The other thing is I think we want to do what, Michael's been doing is buying some of this newer core plus stuff at, low great basis. And right, if they're in a supply area, let's just say Mansfield per se, and you feel like Michael bought a deal in Mansfield a few years ago at, 200 a door, it feels great. We would buy those assets. We'd probably be competitors on those type of assets.
You guys have competed
what's that?
You guys have competed in the past, but how did Michael sneak in a win on a deal that he just closed over in an area that you ride your bike by 3 times a week? How did Michael win that and you didn't get it?
Every time I drive by it, I go, like, what do we not push on the value add? What do we not do? I've always, I'm very familiar with that asset because I ride at White Rock Lake. The last 30, 40 years is one of my favorite rides. Now I can stop in and get some coffee and tell them I know the owner.
That's right. Well, you can ride by my property is 178 a door. It was not a pretty good price. The land's probably worth the dirt's probably worth half the price we paid for it. It's unbelievable dirt.
And your other deal that you bought on Mockingbird, I think you've done a great job on your deal on Mockingbird by SMU, especially putting the mural back up.
Yeah, that Mockingbird 5 looks like a wonderful property that SPI and Michael and his group own. Michael, talk a little bit more about this opportunity that Mike drives by. How did you guys find it? Tell us a little bit about the background of that.
Yeah, it was actually a listed deal. It's called Winstead at White Rock. We just closed on it, and we're actually doing a post-closing equity raise, Paul. We had the timeline got a little backwards with the seller having a pretty protracted process, but had a loan maturity on them, so we had to close. So we closed at the end of September, and we closed with a family office that helped us kind of take the deal down. And we're doing a post-closing equity raise. So I'll do a shameless plug. If you guys are interested in that, just go to our website, which is
I think you should send
SPIadvisory.com. Yeah. So, but yeah, it's great. So, I think Paul really what we liked about it was just, it's like a almost a core location. I mean, it's in the Lakewood neighborhood. It's a mile from my house. It's one of the, top 3 or 4 neighborhoods in all of Dallas-Fort Worth. It's,
What does core mean to any of the new investors out there? What does that mean? Or even core plus? What is that?
expensive dirt, and this I would probably call this a bulletproof location, or is about as close as you're going to get in Dallas for a bulletproof location. Was in my mind, there's Mike can disagree with me on anything I say, but I think there's about 3 supply constrained submarkets in all of Dallas-Fort Worth. You got Lakewood, where this is located. You got the Park Cities, Highland Park and University Park, and you got South Lake, and that's about it. Everywhere else you could build an apartment building in Dallas-Fort Worth, and probably hell of Texas for the most part. So this is a really low supply pocket. It's owned to the best elementary school in the entire city of Dallas, and the dirt's exceedingly expensive, and you have the best natural amenity in the entire city, White Rock Lake, which Mike Ochstein rides his bike around 3-4 times a week for the last 40 years probably. So him and all his little biking buddies drive right down my street every day, going to the lake and riding around it. That's what we liked about it, and it was the price. I mean, if you put to replace this thing, it's probably 100,000 unit on top of our basis. Obviously, we have a little bit more vintage property, being late 90s, so it's not as nice as the brand new stuff, but it's got 9-foot ceilings, and it's got a structured parking on the backside of it, and it's real expensive to build. And what I like about it, is I think, just not only just the fundamentals of the real estate, but what I'm kind of thinking is this moment in time is probably the best moment, I would say arguably, since probably 2011 to 2013 to enter the market. So I think that's probably what Mike is saying in a different way is, he's getting excited because, values are down about a third from the peak, so we're a third off, and that, or you can buy the Dow Jones at all-time high. Is what I think I kind of heard him say. I personally think that Class A and A minus is off the bottom. I think the bottom was October of last year when the 10-year Treasury hit 5%. As what I think Mike was saying, because he's seeing a lot of EQR and Blackstone and all these guys are out buying. So the institutions are back, and the institutions are front running. What they're seeing is what I think is the main thing that's about to come is the materially lower amount of new deliveries we're about to see as we enter into 2025. I mean, it's going to be a meaningful decline in new supply from the last couple of years to what caught probably really the second half of next year, 25, and through 26 and 27, which I think will lead to tremendous rental rate growth. And then finally, you got the interest rates just got cut in the September 18th meeting, 50 bips. So they've signaled they're going to cut more rates. That should be helpful, so especially the short end of the rates, they're directionally going lower, and, seeing a lot more lending options. Paul, you could talk to that. I mean, it's been just the agencies, Fannie and Freddie, and life insurance companies for the most part. Now, some of these banks have kind of cleaned their act up. They're starting to get back in, realizing they need to make loans to stay in business. So I think more and more liquidity is coming at it. The investor demand and interest is increasing. Interest rates are going down, and the supply is going to be meaningfully lower in 2025, kind of second half going forward. So I think that's kind of the recipe that, I've kind of coined it like a generational buying opportunity. It's the best buying opportunity in this generation. You have to go back, 12, 13 years ago to see a similar setup, I think.
Yeah, Mike Ochstein is not a good seller. I can tell you that. He does not like to sell, but when he sells, and some of our clients have bought his properties, I can tell you Mike Ochstein's financials on these properties, the help of Renee, who kind of runs his property management company. I've never seen higher quality, right to the dime, accurate financial statements coming off these properties. So if we're going to put shameless plugs in, I'm going to put a shameless plug in for Price Realty and the way that they handle their operations on their properties. Mike, you own a couple really nice properties up in North Dallas. What's the next generation of all these amenities? If you are taking a property here and you're going to bring it up higher, what's the next thing that you're seeing for amenities besides the coffee machines and the dog parks and things like that? What are you thinking about adding to some of your properties?
Well, I mean, a lot of the assets that we own in DFW are, mid 80s products. So really, we'll continue to, upgrade those units with the better appliances, redoing, I mean, standard stuff that's going on now, just, upgrading them to, to the newer quality with cabinets, lighting, flooring. We're not going to go overboard on those because you're limited on how much rent you can get for them. But you constantly,
as rent, as we say,
yeah,
as rent, as we say, is a big important thing, because in comparison to trying to buy these days, I mean, I think if you're going to rent a property, one of Mike's properties up in North Dallas, $1,700 to $2,300 a month in rent. If you're going to buy a house in that same general area, kids go to the same schools, you shop in the same supermarkets, grocery stores in that area, you could have $4,200 a month mortgage payments. So Mike does a great job. Ochstein does a great job of keeping high quality tenants and high quality assets. And he continues to always update and upgrade these properties to keep his occupancy up as high as possible. Another thing I like about Mike is his long-term perspective. He's not in there for 2-3 years of going in and kind of speculating the market. He is a long-term investor that takes long-term fixed rates. I mean, that's why he has all of his hair on his head, because, he set it and forget it. And he doesn't have to worry about balloons or maturities coming fairly quickly from the period of time that he started. Any more comments, Ochstein, on that?
No, I mean, when your workforce tenant is maintaining them, keeping them clean, continuing to upgrade them, as I've always said, they're like a block of ice, and you got to keep refreezing them and continue to put money away for rainy days. Because, these assets that we own on Preston Road, we'll never sell them. They're going to be generational holds. Standard at City Line will be another generational hold. You can't get any better than in Renner and 75. We were like the first ones in that neighborhood. Picked it up for $180 a door. We're the cheapest one in the block, and that's a newer asset that is going to continue to upgrade. That's probably going to be the next upgrade, because they had carpet throughout. They didn't frame in the mirrors. They used, probably got to start upgrading the appliance package, etc. But that'll be another generational hold. It's an irreplaceable location in our mind.
At the Old Capital Conference, people you're going to be there, Mike Ochstein and Price Realty, and some of your guys are going to be there. That hopefully, if you are an investor and you want to talk with Mike, what's the kind of the number one or number two questions that you get from people that want to invest in apartments? What are they asking you? You have some seniority in this business. People respect you. The lenders love you and your financials. They know everything about you. What good advice are you giving people that want to come into this market right now?
Right now, I would say that, you got to pick the right operator. That's critical. I think the biggest question, are we going to lose money? I think, 30 years into, I've never lost a dime for any investor ever. Make sure that your syndicator, your operator has skin in the game, substantial skin in the game, like Michael does. And you go drive Michael's properties, are all well managed, and that's critical. You got a lot of investors that put 100, 200 grand, that's a lot of money to those, the smaller LPs, and the risk of losing that capital, I think it's minimal, especially in the multifamily world, if you're with the right operator. So that's critical. The other plan is, how long is my money tied up? Well, I tell all my investors, we're in it for the long term. We don't need to be holding these things for, do the big value add, flip them in 3 years. I think that game's over with. It's a long-term game, and that's why you got to buy quality in the right locations. Our plan really is to buy these things. The other thing we're excited about this market, that if you are buying at these higher cap rates and you are putting these higher debts, and the market has been kind of flat, that down the road we'll be able to refinance and return capital, or get them caught up to their pref and continue to hold and cash flow these assets. I just think it's a great generational cash flow business. Where else can you buy quality assets and great locations and continue to produce cash flow?
Yeah. You guys must have gone to the same school, because you're reading off the same kind of sheet of music. Michael Becker, what's your final thoughts?
Mike's been around a long time, so he's done it right, and someone that kind of look up to in the business of someone that's done the right things for a long time and got good quality locations. So I definitely agree. Whether it's a little bit older or a little bit newer, we bought some older stuff recently that in a sub-market that we've done really well in for many years up in Denton, and then it was 5 for 5 at Denton, so we bought 2 deals. So hopefully I'm planning on going 7 for 7 in Denton once we get these deals kind of repositioned. And then we're buying the deal back in my backyard in town. So I think, location is number one. as we kind of thought at our company, Paul, last couple of years, we saw some dislocation coming. Figured it'd be probably most acute in the older vintage stuff, just with newer, less experienced operators coming in, the bridge debt that was prevalent in that space. There was going to be some pain, and we've seen some of that play out. We haven't seen it all fully flush out, I don't think, in the workforce housing, but a lot of that's kind of starting to clear as we kind of talk today. And it's really want to focus on location. So when you go back, it's buying in Bedford or Hearst or Carrollton is very different than buying in South Dallas or East Fort Worth from a crime and quality of tenant profile and things like that. So just making sure the asset might look very similar from a physical standpoint, but the location is very different. So, as you're, kind of getting into this business, understanding the location, and whether you don't know it yourself, is making sure you're with somebody that understands the market and the submarkets that you're in, the nuances of, South Irving is very different than from South Dallas. So just kind of understanding those two things, I think are very critical. And, as I was kind of doing earlier, I was kind of banging my ring on the table. I mean, I think now's the time. I mean, if you've been waiting around, I mean, I think this is the time to go. I don't see, no one's going to put the mission banner accomplished up or wave the all clear sign for you, I mean, but with the supply falling, rates are directionally lower, liquidity is coming back in, the institutions are already in the market, more of them are coming, the election's going to be over. No matter which way it goes, we're all kind of understanding the rules of the road. The calendar is going to flip to 2025. And I think we go, and then it's going to be quicker in Dallas, it's going to be slower in Austin. And I don't know about Houston. I'll let Mike talk about Houston, but I mean, I think we're back basically. They're not saying it's a perfect straight line there, and there's not going to be challenges along the way. But by and large, I think the headwinds are in the process of switching to tailwinds. And I don't think we got 10-year running ahead of us, Paul. But 4 or 5 years of solid expansion in our space. I mean, we've been through a recession. We've seen values decline. I think the rest of the economy has held up better than a lot of the apartments. So I think it's kind of time for that to switch once the supply, falls off the cliff here in the coming months.
So what is Michael Becker's rule number one? Michael Becker?
Don't buy in the hood. Yep.
Don't buy in the hood. So I've been just taking some notes here. Location is everything in real estate, especially in multifamily. You got to be careful when you, number two, is really work with great operators that kind of know the marketplace. Work with local operators. So I think that's one of the reasons why Michael Becker and Michael Ochstein don't go to other areas in the country, because they know this back door of North Texas better than anybody, so to speak, because they know the vendors that supply some of the refrigerators, or they know who's the tough city and person that does all the review of the properties. The city
code enforcement's the word you're looking for, I think.
Yeah, code enforcement people. I was trying to be nice about it. There's a worse word like I was thinking of, but the city code enforcements, they know all the people that are surrounding in these individual markets. So I don't know how some of these apartment syndicators go from Tennessee, then to Little Rock, and then to Waco, Texas, and then Albuquerque, and they're all over the frickin' place. You go with operators that are concentrated in 1 or 2 or 3 areas in their back door that they know, because they have the inside information and they build these deep relationships with the realtors. Michael Becker knows everybody intimately that sells Michael stuff, because Michael gets first crack at it. Michael Ochstein, who's been doing this for a long period of time, he's like kind of the dean of multifamily housing in the Dallas-Fort Worth area. Everybody knows him, knows that if he says it's going to close, it's going to close. So he always, both these two guys get always first crack at stuff. So Michael Ochstein, I do appreciate you spend some time with us. I know you'll be at the Old Capitol Conference. If someone doesn't visit with you there at the conference, what's the best way for people to get a hold of you, Michael Ochstein?
My cell number is 214-957-5228. Feel free to call me 24/7.
That's a little too intimate. But we'll take that. But really look for Price Realty in the Dallas-Fort Worth area.
And my twin son will be there, Jonathan Ochstein. He plans on taking over eventually. He'll be at the old conference. So reach out to Jonathan Ochstein.
Yeah, Jonathan Ochstein is kind of the gatekeeper to get a hold of Michael Ochstein. So guys at Price Realty, thank you very much for spending some time with us and then coming to the Old Capital Conference. We appreciate that. Michael Becker, any final words before we sign off?
No, appreciate the time, Mike. Look forward to seeing you. And within a week, I guess, as this probably comes out. So I look forward to seeing everyone else at the conference. Yeah, if you guys haven't already signed up and bought your ticket, it's probably last call as you're hearing my voice right now. So go ahead, do it. It'll be a few hundred of your new best friends will be there, and all the guys in the business actually doing deals in the marketplace, the brokers, the principals, passive investors, sponsors, et cetera. A lot of people will be in this room that you should get to know.
Yeah, we're not offering any mentoring or education. There's nothing to run down to the back of the room and sign up for $25,000 or $30,000. We don't want your money. We just want to educate you and make sure you know before you invest about what's going on. So again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.